Ever wonder why buying your dream home feels expensive until you see what investors pay at closing? The difference isn't just about square footage. It's about what the banks think you're up to. Imagine you're standing in a title office, checkbook ready, about to close on a property. The stack of papers in front of you looks identical to what your neighbor signed last month. But here's the twist. Your closing costs could be thousands of dollars higher, and it has nothing to do with the property itself. So what's really driving this gap? It starts with how lenders see risk. When you're moving into a house as your primary residence, banks sleep a little easier at night. Owner-occupants typically pay between 2 and 5% of the purchase price in closing costs. That's your title insurance, your appraisal fees, your origination charges, the usual suspects. But investors, they're playing a different game entirely. Lenders know you're not decorating a nursery or arguing about paint colors. You're calculating cash flow and exit strategies. That makes you a slightly bigger gamble in their eyes, even if your credit score is pristine. Here's where it gets interesting. Investors often face higher interest rates, which cascade into bigger costs across the board. A quarter-point difference might sound trivial until you multiply it across a 30-year mortgage. Suddenly, you're looking at thousands in additional expenses before you've collected a single rent check. Then there's the down payment dance. Owner-occupants can sometimes waltz in with as little as 3% down on certain loans. Investors? Most lenders want at least 20 to 25% upfront, and that's if you're lucky. But wait, there's more hidden beneath the surface. Investment properties often require more extensive appraisals because lenders want to verify the income potential, not just the property value. That means you're paying for someone to analyze rental comps and market trends, adding hundreds to your closing tab. Title insurance costs can differ too, especially if you're buying properties in rapid succession. Some investors pay commercial rates instead of residential rates. It's like getting charged for a fancy dinner when you thought you ordered off the value menu. Now picture this scenario. 2 buyers purchase identical duplexes on the same street for $200,000 each. One plans to live in half and rent the other half. The other is a pure investor looking for passive income. The owner-occupant might close with $4,000 in fees. The investor could easily pay $6,000 to $8,000 or more. Same property, same neighborhood, wildly different receipts. Some cry foul, arguing it's discrimination disguised as risk assessment. Others insist it's just math statistics show investment properties have higher default rates during economic downturns. Who's right? Probably both, depending on which side of the closing table you're sitting. But here's what the critics miss. Those higher upfront costs often come with flexibility that owner-occupants can't touch. Investors can deduct closing costs as business expenses, turning Uncle Sam into an unlikely partner. Suddenly, that extra $2,000 becomes a strategic tax play rather than a pure loss. The system keeps evolving too. Some lenders now offer investor-friendly programs with lower fees if you're buying multiple properties or have established relationships. Innovation always finds a loophole when there's profit to be made. Despite regulatory attempts to standardize and simplify, the closing cost gap persists like an inside joke that everyone's in on except first-time investors. The forms get longer, the disclosures get clearer, but that premium for investment intent never quite disappears. So where does this leave you if you're eyeing that duplex or considering your first rental property? Knowledge becomes your best negotiating tool. Understanding why you're paying more helps you shop smarter and push back harder. Some investors factor these costs into their purchase offers, effectively making sellers absorb part of the premium. Others build relationships with lenders who specialize in investment properties and offer competitive pricing. The game rewards those who do their homework. And here's the beautiful irony. While owner-occupants pay less at closing, investors build wealth that can dwarf those initial savings within a few years. Those extra thousands up front become rounding errors when you're collecting monthly cash flow and building equity across multiple properties. The landscape keeps shifting as new financing products emerge and old ones disappear. What worked 5 years ago might be obsolete tomorrow. But one constant remains: investors who understand the true cost of entry make better decisions than those flying blind. That's the hidden reality behind every closing statement. The numbers tell a story about risk, reward, and who banks really trust with their money. But here's the thing, tomorrow's closing might look entirely different as markets evolve and new players shake up the lending game. If you're ready to navigate these waters and find properties where the numbers actually work, despite those higher costs, head over to www.growthsense.com, your directory for discovering real estate investment opportunities that turn closing costs into footnotes on your path to building serious wealth.